This is Nightly Business Report with Bill Griffith and Sue Herrera.
High gear. The economy grows at its fastest pace in 4 years, and some say it can expand even faster.
Black eye, CBS shares tumble on reports of alleged misconduct by CEO Les Moonves, a man considered a titan in the broadcast business.
Open House, one of the most visible marketing tools in real estate, is getting its first makeover in more than a century. Those stories and more tonight on Nightly Business Report for Friday, July 27th.
And we do bid you a good Friday evening, everybody. Welcome. In case you hadn't noticed, the economy is firing on all cylinders right now. A new report out today said that second quarter growth came in at 4.1%. That's nearly double the first quarter's rate and the strongest pace we've seen since 2014. Consumer spending bounced back during the quarter. Business investment picked up. So now investors are wondering if the economy has entered a new era of faster growth. Steve Leisman takes a look for us.
U.S. economic growth came in at a strong 4.1% for the second quarter, the best number in 4 years, and barely an hour after it was released. President Trump took a victory lap on the South Lawn.
These numbers are very, very sustainable. This isn't a one-time shot. I happen to think we're going to do extraordinarily well in our next report, next quarter. I think it's going to be outstanding.
Some observers concur that these strong numbers can keep going. The GDP report showed strong growth in consumer spending and business investment, along with government spending driven especially by defense outlays. But there was also a bump from trade that some economists think came from foreign buyers purchasing U.S. products before tariffs drove up their price.
What I was looking for is how much of this number was going to be sort of, soybeans is going to be the trade stuff. How much was going to be sort of kind of the sugary stimulus stuff? I think we saw that in the consumer numbers.
There's little doubt that growth is strong, but few economists think the economy has the stamina to keep doing laps at a 4% annual rate. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to Joe Busuelas for more on the economy. He is the chief economist with RSM. Good to see you, Joe. Welcome back.
Good to see you. Thank you.
I guess that is the question. Is this type of growth sustainable?
Well, not at 4.1%. It's not. You're going to see the economy continue to grow at just under 3%, probably for at least the next quarter or two. We'll pick up in the last quarter of the year and finish just above 3% for the entire year of 2018. You know what the best news was about this? Was the way consumption picked up. It's very clear that individuals at the lower end of the income ladder are beginning to spend. We're starting to see classic late cycle business dynamics, and this is good news. It's been a long time since the economy's grown like this. Everybody should enjoy it.
Yeah, the tight labor market certainly helps in that area. But we are just this week we heard from a number of companies that talked about higher costs related to the tariffs that we're seeing being imposed right now. That's going to take a toll at some point in consumption, don't you think?
Well, that's right. So later this year and into early 2019, you're going to see the impact of the trade conflict. In fact, you saw sort of a counterintuitive impact in today's number. One of the reasons why the growth was so strong was a full 1 percentage point contribution was via the export channel, right, primarily due to the Chinese mopping up every single commodity they could before the trade conflict commenced.
So where does this put the Fed at this point? Because we do have another Fed meeting coming up next week. If growth is that hot, do they have to be more aggressive? Or if it's going to cool down, can they stand pat? What do you think?
Well, I think that, they have to watch what goes on in policy world, especially around the trade conflict. There's no need to pick up the pace. I think 2 rate hikes of 25 basis points this year is entirely appropriate, and 3 next year. When we get to the middle of next year in June, that's when the Fed's going to have to make a very difficult decision on just how long do they want to keep the rate hike campaign in place.
And inflation, what do you see there?
Well, so the consumer price index is sitting at around 2.9%. I expect it to rise a little bit and then ease back to just around 2.7 to 2.8. Inflation's going to be quiescent, but if the trade conflict accelerates, we want to revisit that forecast, and you're going to be looking at much higher inflation into 2019.
And a lot of people are pointing to the tariff situation, and if it goes on for a long time, that might be one of the tipping points that brings that recession word back into play. Would you agree with that or not?
Well, quoting the R word's a bit premature from my point of view. But the steel and aluminum tariffs in place right now, for every one job that it creates in the steel and aluminum industry, you'll lose 5 in other industries. So this is something that we'll want to watch with respect to growth because, you know, it's been over 7 decades since we've had a true trade war. And given the integration of what are called global supply and value chains, it's difficult to accurately measure how this particular trade conflict is going to impact our new globalized economy.
Joe, thank you so much. Joe
Thank you.
Brusuelas with RSM. Bill?
So on Wall Street, the strong report on the economy was not enough to offset a decline in technology shares. Dow component Intel fell sharply today, down more than 8% following that disappointing earnings report that we told you about last night. And Twitter shares fell even more, down more than 20% today after it reported a decline in active users. We'll have more about that later. The Dow fell 76 points to 25,451. The NASDAQ down 114 today. The S&P lost 18. For the week, the Dow was the big winner, up about 1.5%, while the NASDAQ was down 1%.
A climb in the price of oil in the second quarter wasn't enough to drive earnings at 2 of the world's largest oil producers. Dow components Exxon and Chevron both reported disappointing profits, but for different reasons. Jackie DeAngelis explains.
The big 3 energy companies reported this morning, and results were mixed, leaving a murky picture for Wall Street on what to expect next. Exxon and Chevron missed this morning. The bar was high, and it wasn't met. Exxon blamed its miss on refinery maintenance costs, the downstream business. Its capital expenditures surged, but those costs were not offset. The company said that oil prices alone would have helped boost earnings by $1 billion.
This is planned maintenance. It goes in peaks and troughs. We take these turnarounds on these refineries at different times. They come every several years. And we just had a peak in the second quarter. So it was a large amount. We had several refineries down. And of course, you get the double impact when the refinery's down. First of all, you lose the volume, and at these strong margins, that's a big impact on earnings. And these are big maintenance activities. And so we spend a lot of operating expense.
Meantime, Chevron said profits doubled from a year ago, but it also saw weakness in refining. Interest expenses had a higher impact than previous quarters, and even though the company said it will start returning cash to shareholders and buying back stock, its shares saw a drop as well.
For an apples-to-apples comparison, underlying cash generation improved between the first and second quarter by about $500 million. This improvement reflected higher Brent prices of about $7.50 per barrel and higher WTI prices of about $5 per barrel. Our upstream realizations did not fully capture the quarterly increase in global oil prices, largely due to portfolio mix effects surrounding the Brent-WTI differential.
Oil giant ConocoPhillips led the pack earlier in the week. Profits beat expectations. Higher oil and natural gas prices were helpful during the quarter, as oil was hovering close to $70 a barrel. Conoco's guidance was also upbeat. The company bumped its capital expenditures, a sign that its business and the market are strong. It also raised production expectations. But when Exxon and Chevron are down, they take the sector with them. The issue going forward is if higher oil prices weren't the answer for big oil this quarter, what will happen after August when seasonally prices dip and the environment isn't as favorable? Analysts are bracing for big oil to continue to struggle. And even more questions as BP agreed to buy $10.5 billion in shale assets from BHP Billiton. A good time for BHP to sell at a high price, but will that investment pay off in the near term for BP? For a Nightly Business Report, I'm Jackie DeAngelis.
Meanwhile, fellow Dow component Merck topped earnings forecasts and raised its guidance, and it was one product in particular that helped power that drug giant's profits. Meg Terrell has that story for us.
A big driver of Merck's strong quarter, the cancer drug Keytruda, whose sales rose almost 90% to $1.7 billion. First approved in 2014, the medicine is now FDA cleared to treat 9 different kinds of cancer, from lung to lymphoma to melanoma. It was for that type of cancer that Keytruda was famously used to treat former President Jimmy Carter, and credited in late 2015 with helping to shrink the tumors in his brain.
This week, they didn't find any cancer at all.
Keytruda is part of a new wave of cancer treatment known as immunotherapy. Some cancer cells have the ability to hide from the body's immune system, but drugs like Keytruda and others like Bristol Myers' Opdivo unveil cancer cells so that our natural immune defenses can attack. Merck and Bristol Myers have been locked in a head-to-head battle for immunotherapy dominance. And today, for the first time, Merck's Keytruda posted higher quarterly sales.
We think Opdivo and Keytruda are very similar. However, Keytruda was able to show very strong efficacy in lung cancer, again, one of the largest indications in oncology, and that's really pushed Keytruda ahead.
And while Keytruda has improved outcomes in many different kinds of cancer, it hasn't worked in every clinical trial, and it doesn't work for every patient. In a trial of about 300 patients with advanced non-small cell lung cancer, 45% of those taking Keytruda saw their tumors shrink, compared with 28% on chemotherapy. And like any medicine, it doesn't come without side effects. In this case, the concern that the immune system may attack other parts of the body, such as organs. And Keytruda carries a price tag of more than $12,000 a month, or as much as $150,000 a year. For Merck, the drug has been such a success, Wall Street wonders if the pharmaceutical giant could be too dependent on it for growth. Morningstar analyst Damian Conover, though, sees Keytruda growing to sales of $15 billion a year by 2022. For Nightly Business Report, I'm Meg Terrell.
As you know by now, it was a very busy week for earnings. And as Bob Pisani reports, a few key issues have emerged.
We're just past the halfway point for second quarter earnings, and there's several trends that are already coming into focus. Even with high-profile misses from the likes of Facebook, earnings and revenues for the second quarter are higher than expected, and estimates for the third quarter are holding up, and that is good news. Earnings growth is running above 22%, and revenues up almost 9%. There are several sub-trends that are apparent so far. First, companies that are missing the numbers largely because of higher costs are mostly those companies exposed to the steel and aluminum tariffs, like a General Motors or a Whirlpool. Second, there's a split between those who can afford to raise prices due to the higher costs and those who can't, like Colgate-Palmolive, who reported this morning. Those who can't face margin erosion. That's a problem. Third, not all raised guidance is the same. Some companies provided a little bit higher guidance. In theory, that's a good thing, but often it was not enough to impress investors. Just look at Boeing and Northrop Grumman. Next, the dollar's becoming more of an issue. Many companies with large operations overseas, like Coca-Cola, General Motors, they mention the dollar strength as a potential headwind. Finally, there's growing concerns that tech and social media profits might take a hit from higher regulatory costs, particularly in Europe, where there's new data protection regulations that are now in effect. This is an issue for Facebook, it was an issue for Alphabet, an issue for Spotify, and for Twitter. And while everybody is focused on tariffs, it's the tax cuts that really matter. That's one of the things powering the markets. The bottom line is the overall market's holding up well because of revenue growth, tax cuts, and no cuts to earnings in the third and fourth quarter. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And it's time to take a look at some of today's upgrades and downgrades right now. Analysts at just about every major Wall Street bank and brokerage issued a report on Amazon today. Many hiked their price targets, including J.P. Morgan, which upped its target to $2,200 on that stock. The analysts there cited Amazon's significant profit growth that we saw in the second quarter following that earnings report last night. The rating remains at overweight. And today's shares closed at $1,817.20, up 0.5%. Meanwhile, Intel was downgraded by a couple of firms, including Citi, which cut its rating to neutral from buy. The analysts there cited a host of margin headwinds after Intel's disappointing earnings report. Price target $50. Today, Intel finished at $47.68, down more than 8% in today's trade.
Juniper Networks was downgraded to market perform from outperform at BMO Capital Markets. The analyst cites potential problems with Juniper's cloud business following the company's disappointing revenue and margin guidance. The price target is $27. Today, Juniper dropped $2 to $26.18. Mattel was upgraded to neutral from underperform at D.A. Davidson. The analyst cites the possibility of a takeover of Mattel. The price target is $14. Mattel lost a couple of pennies today to close at $15.58.
Still ahead, CBS's board investigates his CEO and the stock drops.
CBS shareholders got a surprise today. A report released by The New Yorker alleges sexual misconduct by CEO Les Moonves, who was credited with helping make CBS a TV juggernaut. CBS put out a statement saying, quote, "All allegations of personal misconduct are to be taken seriously. The independent directors of CBS have committed to investigating claims that violate the company's clear policies in that regard," end quote. And the shares tumbled. Julia Borston takes a look at why the reaction was sharp and steep.
CBS's board investigation into CEO Les Moonves comes as the company is in the midst of a legal battle with its and Viacom's controlling shareholder, Shari Redstone's National Amusements. After she advocated for a combination of the two companies, CBS, led by Moonves, sued to issue a special dividend, additional shares, to dramatically dilute Redstone's controlling stake to prevent a forced merger. Redstone sued back, saying the company had no rights to eliminate National Amusements' voting control. On today's news of an investigation into Moonves, which could threaten his leadership, Viacom shares moved higher and CBS shares moved lower, on the perception that CBS's board's investigation could threaten Moonves' leadership of CBS, making it more likely that a merger between CBS and Viacom happen. Moonves has been lauded for his leadership of CBS since it split from Viacom back on January 1st, 2006. In that 12 and a half years, Moonves bucked expectations that CBS would be the slower growing of those companies, diversifying the company away from reliance on advertising and growing fees from cable providers and digital revenues. CBS shares have surged since then. In contrast, Viacom shares are in the red over that same period, as its networks have struggled with the declining ratings and ad revenue, and its studio has suffered from a number of years without massive breakout hits.
Not only is Leslie Moonves one of the last old school Hollywood moguls, he is perhaps the most closely identified CEO with his company of all media companies. He is CBS and CBS is Les Moonves. So for there to be any change at that company, if he leaves or if he's demoted or whatever happens, that would be gigantic for CBS.
A Cowen analyst saying that if the claims turn out to have merit, they would expect Moonves would be forced to step down, increasing the likelihood the Redstones prevail in combining CBS and Viacom, warning that Viacom shareholders would not reap a substantial premium and that, quote, the effect on CBS as a business would be somewhat shattering, with several other key executives likely leaving. Now it's not just Les Moonves' future that hangs in the balance, but that of CBS and Viacom shareholders as well. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Disney gets the green light from shareholders to buy 21st Century Fox assets, and that's where we begin tonight's market focus. Shareholders of both companies voted to approve the more than $71 billion deal that gives Disney control over Fox's entertainment properties and a minority stake in Sky. The approval comes after months of uncertainty, with Disney and Comcast at one point engaging in a bidding war, which ended when Comcast declined to top Disney's last offer. Shares of Disney were off a fraction to $112.62, 21st Century Fox off slightly to $45.15. Meanwhile, Charter Communications may be in jeopardy of having its merger agreement with Time Warner Cable pulled. The New York State Public Service Commission has voted to revoke its approval of that 2016 deal, alleging that Charter did not make good on its promise to expand high-speed broadband network access in New York. Charter also risks losing its authorization to operate in the state. Shares of Charter fell fractionally today to $286.29. And Twitter's earnings may have matched estimates and revenue was a beat, but all the focus was on that decline in monthly active users. The social media platform lost 1 million users in the quarter and said that it expects additional declines as well. The company attributed the drop to new privacy regulations in Europe and to its efforts to clean up the platform. It's also forecasting a weaker than expected profit for the current quarter. Twitter shares plunging 20% today to $34.12.
Goodyear Tire topped earnings expectations and said it gained market share this past quarter. The tire maker also said higher materials costs and a strong dollar would cause operating income for the year to come in lower than initially thought. But investors didn't seem to care. They sent the shares up more than 9% to $23.15. And AbbVie said a rise in sales for its drugs helped earnings top expectations. The company also raised its full-year guidance. But that news was overshadowed by concerns that the company's key arthritis treatment is experiencing slower sales growth. Shares of AbbVie were off 3% to $90.56.
Now to our weekly market monitor, who is looking at stocks that he says are the nuts and bolts of the economic recovery that also provide stability in this current market. This is his first time as a market monitor. He's been with us before, of course. He's Quint Tatro, president and portfolio manager at Jewel Financial. Quint, welcome back. Thanks for joining us.
Thank you. It's great to be here.
And we begin with a company that literally makes nuts and bolts for this economy, Fastenal. Why do you like that?
Well, that's exactly right. You opened with the great phrase, if you want to own the nuts and bolts of economy that's growing at 4.1%, which is incredible, you own the company that makes the nuts and bolts. This is a company that is what we would call a growth at a reasonable price. So they are growing the business and the market is not yet pricing it at a level that is really out of reach. In addition, the company has some very unique ways of increasing their sales. They're moving to on-site locations, actually, get this, operating vending machines that disperse these nuts and bolts for many of their customers. In addition, the stock yields about 2.75% in a healthy dividend, very attractive balance sheet. It's a great company.
Steel Dynamics is your next pick. You say it also has a healthy balance sheet, strong top and bottom line growth. But we've heard a lot about steel and tariffs. Are they susceptible or vulnerable to any of that?
They are, and there's no question about that. And I don't think that that should scare our audience. The rising steel prices are obviously going to impact those that buy steel for their material or for their products and then have to pass that on. Steel Dynamics is the seller of that steel. So they are the benefactor of a rise in steel price, whether that comes from tariffs and trade disagreements or it comes from economic demand. The company doubled its earnings per share, and won't get too crazy in fancy numbers here, but they're only selling at 10 times forward earnings. That's very, very cheap for a company that has just recently doubled their earnings per share this year.
And then finally to your stability play that we mentioned, and that's Pfizer. Why that company?
Well, you got to have some sleeping well at night stocks in your portfolio. As you know, we're very actually concerned about this market in the short to intermediate term. So I think defense is key, and Pfizer is a great defensive play. As with all of our stocks tonight, the stock is not expensive as far as the valuation, which is very important. It's irregardless of price. We want to look at valuation. But here's what's key about Pfizer. With a very, very attractive balance sheet, the company is yielding 3.65% in a dividend and has a very stocked pipeline for future growth. So this is a great defensive name to get good income and probably upside appreciation over time.
Very good. Quint, always good to see you. Thank you. Have a good weekend.
You too.
Quint Tatro with Jewel Financial. And to read more about his picks, you can head to our website at nbr.com.
Coming up, connecting the for sale sign to the digital world. One of the oldest staples of selling real estate is about to get a major makeover to bring it into the digital age. Diana Olick has the story tonight from Washington.
It is the most visible, most effective, and most mundane marketing tool in all of real estate, the for sale sign. It hasn't changed in over a century, until now.
So the amazing thing about the sign is that it's connected and intelligent and illuminating.
Yes, it's a new sign, and it lights up. Compass Brokerage, a new kid on the real estate block, is disrupting the old sign with a high-tech, interactive, smart model soon to be available to all of its approximately 5,000 agents.
We wanted to really consider creating the ecosystem that makes Compass so powerful, which is the combination of data and software and hardware that can help really deliver something of value for our agents and their clients.
The sign will light up when anything comes within a 20-foot radius. If you have the Compass app on your phone, it will send you a notification about the property and will, of course, connect you with the Compass agent. The sign can also direct potential buyers to the house through the Waze navigation app.
We've got beacon technology, Bluetooth technology, and also motion sensors. We see the sign as a part of a connected ecosystem of devices managing the sale of homes in the future. And everything from open house management to digital lock boxes.
The sign is definitely disrupting the industry, but will it disrupt the neighbors, especially if it starts lighting up at 3 a.m.? And given all the expensive technology in the sign, it could be more likely to get stolen.
We don't believe that the signs will be stolen. You can customize these various boards.
But he did add that agents who will pay about $500 for each one will also have insurance on them. The risk is perhaps a small price to pay for a big upgrade that is clearly a sign of the times. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about that real estate sign makeover, head to our website, nbr.com.
Before we go, one last look at the day on Wall Street, capping off a very busy week of earnings. The Dow fell 76. The NASDAQ was the biggest hit today, down 114, with some of the technology stocks down sharply. S&P dropped 18. For the week, though, the Dow was the big winner, up 1.5%, while the NASDAQ was down more than 1%.
Well, we did it. We got through the week.
Yes, we did.
That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a wonderful weekend. We'll see you again on Monday.